Welcome back to the Value Investors Club. I'm your host, Timon Wunderlich. Let's get right into it with VIC readings. This recommendation was filed in on September 23rd by SK601, the Postal Reality Trust Inc., PSTL. This is not a recommendation, only for information. Description. The United States Postal Service, USPS, leases over 70% of their 32,000 properties to private landlords. The lease payments are backed by the full faith and credit of the United States government. In fact, the USPS has never missed a lease payment on its leased properties. USPS pays their rent on time, all of the time, through recessions, depressions, and government shutdowns. The USPS provides the United States with irreplaceable infrastructure servicing critical last mile delivery for e commerce customers like Amazon, UPS, FedEx. Postal Reality Trust, ticker PSTL, is the largest owner of USPS properties. PSTL is executing a scale and public private arbitrage and consolidation thesis in a highly fragmented, about a 14 billion market. PSTL is the number one player with 5% market share, with the next 20 competitors only owning collectively 11% of the market. PSTL's size and public structure and management expertise offer significant advantages in rolling up an underappreciated and highly fragmented market. PSTL owns 1,182 USPS properties, 5.1 million square feet. PSTL trades for $15 per share with 23.2 million FDSO for a market cap of 348 million. PSTL became public in May 2019 via IPO and remains the only publicly listed owner of USPS properties. PSTL has significant advantages: size, a public structure, and management expertise that allow it to earn excess returns on capital as it rolls up and institutionalizes an attractive, underappreciated market. There are 32,000 USPS locations in the United States, 23,000 of which are leased for $1 billion dollars gross annual rent, 14 billion market at a 7% cap rate. PSTL as the leader owns 5% of the market, with the next 20 competitors combining only owning 11%. In fact, there are 6,383 different legal entities that own USPS properties. Most owners are aging, and there's a generational shift in ownership. The average owner has owned for 40 years. PSTL has an advantage by targeting long term owners of single properties that have retained them within their families and face a significant tax liability if sold. It uses its operating partnership units as currency to allow property sellers to defer any potential capital gains tax. As the only publicly listed REIT focused on postal properties, PSTL offers postal property owners a tax efficient disposition and estate planning option. Additionally, PSTL has significant scale advantages as the company can acquire and grow property counts without increasing its G&A base of 20 employees in their corporate headquarters. Scale also affords PSTL with an advantage in sourcing contracts. For example, as a result of PSTL's national insurance and roofing contracts, management estimates that they are able to reduce annual property expenses by approximately 10 cents to 65 cents per square foot as compared to postal properties owned by individual owners. The CEO's father started the business in the early 1980s. Aside from knowing what to avoid and what to look for, the experience affords PSTL an additional advantage in sourcing deals, as evidenced by the fact that 83% of acquisitions in 2022 were sourced off market, 70%, 5% in 2021. Additionally, Patrick Danahoe, a 73rd Postmaster General of the United States Postal Service from 2010 to 2015, serves as an independent director of the board. Management and directors collectively own 13.4% of the fully diluted shares. Since IPO, May 2019, the CEO has received no cash as a salary, instead receiving long-term incentive plans shares in lieu of cash salary. The United States Postal Service provides a strategic and irreplaceable infrastructure to the United States economy. Amazon built out a logistics network throughout the US utilizing the Postal Service last mile. They specifically use a product that Postal Service sells called a Postal Select. Amazon does all the pre-sorting of all packages, drops off the packages at a postal service every day at a certain time, and it's the Postal Service's responsibility to deliver to the customer. T here are high T here are high barriers to replicating the existing infrastructure. USPS delivers to 163 million delivery points every day. And the current system is a win-win for consumers and e-commerce facilitators. Amazon, UPS, FedEx all rely on this critical infrastructure. Additionally, the rental cost of these properties is de minimis to the USPS. Operating lease payments represented only 1.7% of the USPS total operating expenses in fiscal year 2021. PSTL purchases U.S. Postal Service properties in the 6 to 8% cap rate range, and are buying either at or in most cases below $150 per square feet, which management believes is well below replacement cost of these properties. The post office spends $170 to $180 per foot when building a new post office. The leases are structured and as modified double net. Most of the operational expenses are paid for by the government, including regular maintenance, utilities, property taxes. In the S1 from the IPO, the company disclosed annual rent increases of 5.7% per year between 2015 and 2018. PSTL provides a great inflation hedge as rent increases are typically at or above inflation. Although the average lease is structured as a 5-year lease, 38% of PSTL's existing leases renew in the next 3 years, which will drive pure cash flow growth through rent increases. 88% of their debt is fixed, 3.48% weighted average interest rate. WAL of debt is 5.7 years. PSTL has had 98.9% lease renewal rates over the last 10 years and rent collection rates of 100%. The US government pays rent on time every time. Since this is a roll up, which is tricky to value, I approach valuation from a few different perspectives. Annualized, the latest quarter, the stock trades at 15.8x market cap to AFFO. Operating, this is an implied 6.3% yield. Rents will be growing faster than funding costs, and then rents have historically risen in the 5% range. Finger in the air, you're probably safe, earning 9 to 11% here, 6.3% plus 3.5% organic growth, without any further mergers and acquisitions. IRR is likely higher if you believe in two things. The rents are recurring, highly reliable, and backed by the US government, and therefore should command a multiple higher than 10% applied IRR. Acquisitions are accretive to the stock, since IPO management has acquired 335 million in properties and the market cap has only increased 271 million. So, although the stock has stayed flat, you own more value per share than when the company was underwritten in May 2019. Importantly, your downside is limited. This shouldn't trade much lower than 16x AFFO, and you have significant downside protection, as this is trading well below replacement value. At IPO, you were paying $88 per square feet. Today, you're paying $73 per square feet. Per management, anything below 150 square feet on average is below replacement cost. The post office spends 170 to 180 per foot when building a new post office. Putting the above together, you have a situation where there is limited downside aside from US Treasury yields continue to soar higher than expected, which is hedgeable extrinsically and also intrinsically by the fact that PSTL will raise rents in line with inflation faster than debt reprices. And base case, you're earning 9 to 11% with some potential upside in that number through multiple expansion and accretive mergers and acquisition. I do not hold a position with the issuer, such as employment, directorship, or consultancy. I and or others I advise hold a material investment in the issuer's security. Catalyst. Continued execution, awareness, valuation. Thank you very much for tuning in. This is not a recommendation, only for information. See you next.